Welcome back. Well, we've been telling you that we're bracing ourselves for a bit of a downtake to kickstart trade, but a good time then to get you some derivative strategies. We have Rajesh Palvia who joins us, from Axis Securities. Hi, Rajesh. Good to speak to you after a while. Tell us, what are the strategies you're going with today?
Yeah, morning, Nigel. So looking at the setup, looking at the global cues, we feel that market is going to open below 17,500, and then if we trades below 17,500, then a lot of unwinding action we are going to witness on the put writers front, because most of the put writers have created their position at 17,500, 400 zone. So if at all, if we trades below 17,500, then possibly we may go down further towards even 17,300 or 17,100 level on the downside. So setup looks to be on the weak side, and sell on rise would be the strategy till we are not crossing above 17,650 level. That's the major critical level as of now on the higher side. Even for the bank Nifty also, 38,500 is very important level. If we breaks below that level, then possibly it may go further down towards 38,000 level during the day itself. So trend is likely to remain on the weak side for the day as well as for the coming trading session also, and we are suggesting that sell and rise kind of strategy in this market. We feel that IT sector may go further down from the current level. Most of the IT stocks have broken their 50-day as well as 20-day moving average in the last week itself, and most of the stocks are showing weakness. So from IT, we are recommending here to go short in L&T Infotech, LTI. We feel that stock may go down towards 4,600 to 4,580 level. So one can go short with stop loss of 47.40. Another sector which we feel that can show weakness during the day, that is pharma, and Zydus Life is looking weak. Since last 2 weeks, we are seeing that supply pressure is there on the stock. So we are recommending here to go short in Zydus Life for lower target of 370, keep stop loss of 395. One stock which we feel that can show some strength because trend is positive for the stock on the long-term setup also. So Coal India, we are recommending to buy in the dips. One can buy if its stocks available near to 224 with stop loss of 218. Upside target we are expecting around 238 to 245.
Rajesh, thanks very much. Good speaking with you. Thank you very much for your time. So it's going to be a big start, and on big days you need the big guns. Samir Arora is now joining us. He's founder and fund manager at Helios Capital. Samir, great to have you with us here on the program. Thank you very much. I have to say that Samir and his team were one of the first to realize and kind of, in a way, forecast. They were ahead of the curve in calling the market top, that the market is going to head lower. This was very early in the year. And then they turned constructive around the time the market actually bottomed out, mid-June or so. So keeping with that track record, Samir, are we at a bit of an inflection point now? I remember the last time that we spoke, you said, well, what happens after markets sell off quite a bit is not a huge rally. They should stop falling first and consolidate, spend some time. But we got a straight up 18% move higher. What now, Samir?
So I think, first of all, you call me before I can myself take any trades today or do any trades today, because all this happened after market on Friday. But I have to say that we have to give back quite a bit of it. And that is the reason why, every day Mr. Irani with his long only fund doesn't beat my long short fund, is because we have days like this and weeks like this. But I think, even though I have not yet done anything post the announcements and everything, but I think we will give back quite a bit.
Okay. Well, for now, the pre-opening rates are kicking in and it's not looking good. It's quite an ugly picture. The Nifty is down 500 points. Of course, we'll wait for these rates to adjust, but it doesn't look like a good start at all. Metal, cement, power, banks. It's a secular run on the downside, is what we're getting in pre-opening. Samir, good morning. Good to see you bright and early this morning. I just wanted to understand what the outlook is for the rest of the year, because give and take everything, this market has done pretty well.
I think the way to look at it is that we are outperforming. We will again continue to outperform, but I don't think we are going to make more money from here for next 3-4 months. And maybe we give back nearly all of it, or that I don't know. But generally, we can only be happy that India most probably will outperform China, Europe, US, because you can see some specific, even beyond inflation issues, although maybe US is mostly inflation. But But, if those markets are down, and I think now they'll be down quite a bit, then we will outperform. And I think that is the best we can hope for the next few months. Particularly, okay, let's go month by month, who knows? But September, there's nothing new to look except negative things on, US inflation and employment, and then their, 50 or 75 basis point hike. And then for us also, we may be happy with some results, not happy, but that is many weeks away.
Hi, Sameer. Morning. Always good hearing your thoughts. Sameer, what about the long shot? How have you all changed your positioning, say, in the last, in the recent past? If you could give us a sense on that.
It will be changed soon. That's what I said. No, I tell you before I even do many of these things, it has to be changed.
But how are you all positioned as of now? If you could give us...
we would be high. I mean, our normal average for the last... again, I say for 17 years has been 62%, and currently we are at maybe 68 or so, and it should be brought down.
Sameer, so just to press on that point, you said may give back most or all of the gains. You're saying what you mean is from the June lows.
What I mean, easily go back 5-10%, 10%. Or, you say it's 18, but that is precisely from some maybe intraday bottom or something. Broadly, we feel it's up 8-10%, generally speaking. Big picture, because I don't even look at it that micro. For example, if you ask me right now, what is the Sensex? I have no idea what is the number. I only talk in percentages.
No, from the lows of 15,200. Yeah, you're right. That was the intraday low. That's almost 18%, 18.5%.
How much?
18.5%.
That's what I'm saying. You said 18. If you had asked me without this, I would have said maybe it's up 12, 13% or 10, 15%. So in that big picture context, I'm saying it can lose 8, 10%. Yeah. But I don't know exactly whether it is supposed to hit some magical number or not. The point being that, if those guys increase their rates, although we may say not connected with us, but then that creates a lot of problem for RBI, whether they should increase rates, or if not, then what to do with currency. Well, they can do one thing. They can raise money from NRIs, and they can get 30-40 billion if they want, and maybe then they don't have to raise rates, or they don't have to defend the currency via rates. But all these things are a bit complicated and are not going to happen in 2 weeks. So there will be good uncertainty, high uncertainty. And also, if you look at the language, although, we have discussed this in the past where Powell was asked that, will you take draconian measures if needed? And, instead of saying, no, draconian is a bit too much. This I'm talking about March, from the time I became really negative. He says, let history record that my answer is yes. Now, what kind of language is that from like a Game of Thrones kind of thing, which means you are totally committed to say, let history record that my answer is yes. So if he was in March saying that he will take whatever, and the word exactly was that, will you do whatever it takes? And then one Fed, which was Volcker, had taken draconian measures. So would you do the same? And instead of saying, yeah, I'll try, I have to manage this, that, he said, let history record that my answer is yes. So now he seems to be again trying to reestablish his credibility, because if you look at some of the discussions that even I see on Twitter with me, people say, oh, the US cannot handle, they are hooked on easy liquidity, they are hooked on easing, and therefore they will not do. And I say, well, I don't know, but this guy just said a few weeks ago that I will take draconian measures. So that basically in simple terms means that the markets, including me for 2 months, were enjoying and saying that, okay, things are over and it is peaked and therefore it is on the way down. But they are saying it is not enough for inflation to have peaked, but for us to see that it is going to 2%. In the long term, they may have to change this 2%, I think, but not today. You can't do it in the middle and say, no, I have made my goal 3%. But when it is going towards 3, maybe one day somebody will say that because we are doing less globalization, because we want to not rely totally on China, we will do some things here, and the cost of that is some 50 basis points higher inflation, but that is a trade-off. But you can't do that today. So today, if they've just again said it, we have to believe that this is not ending right now.
Yeah. Nobody was expecting a pivot or anything, right? I mean, but I think what has happened maybe is that in terms of what has changed for the market is those who were expecting some rate cuts in the second half of next year, first half of next year, that is now out of the picture.
Yeah, so that's a dovish pivot in the sense that even though you're raising rates, you keep talking about, or you hint that don't worry, next year it's over. So you just look at it as a 1-year issue or 6-month issue. But if you say, no, it's longer, whatever, higher for longer or whatever, and you say that we will take whatever their long-term trend growth has sort of par for the course, then yeah, it's been bad right now. I'm in a bad mood today early morning just because I'm wearing a cotton shirt at home. It looks very colorful, but I ain't feeling colorful.
You're looking cheerful, so if that that works, I think. You can manifest your moods, right? You know that. I mean, look cheerful. Maybe the markets will pick up. You never know. But Samir, by the way, just want to point out that the rupee has hit. Yeah, go ahead.
Try this. Sorry, one thing. You must try. Put a pencil here, and you can't be angry. If your face is always smiling, you cannot be angry, even if you force a smile. This is from the book Thinking Fast and Slow. Okay, yes, sorry, your question.
No, that would work. I don't think I need it. I mean, I'm smiling all the time, so I don't need a pencil over there. But I mean, for tough times maybe. But I just want to point out that the rupee has hit a record low of 80, and I think this was coming because forex reserves had also slumped to an over 2-year low, and there was some RBI intervention to prevent the rupee from, crossing that 80 mark. But today, once again, the rupee is at a fresh record low of 80.08. Samir, back home, there is a big move that we're seeing in a lot of the consumption stocks, whether it's auto stocks, whether it's the FMCG basket, the Jubilant Foods of the world. This entire pocket has picked up, and one step out into the markets, into, a mall, and you'll get a sense that consumption has come back in a big way, even real estate for that matter. Is this a space that you like?
So, we have liked the sort of the low ticket consumption, if you call it that. And now if I want to make it a second round event, that if interest rates have to go up, even in India, just to, not have the currency depreciate, then impact of that will be on your auto and maybe a little bit of real estate, but not so much on your going to the mall or you're going to buy shoes or wedding dresses or whatever stocks we have. So broadly speaking, I would still think that consumer low ticket is better, because in the end, I think the Indian economy is doing relatively better. You just compare it to what is happening in Europe, what is happening in China, where they are now saying some 3.5% GDP growth, and US, because they want to, even if the economy is doing well, they want to bring it down in some sense to make financial conditions tighter. So in that relative sense, there are only 4 big pockets in the world: US, Europe, China, India, and India is very good. So we can't totally walk away from India. We just have to, reduce our exposure a little bit to some things which may be more direct. So I would think I like consumer, but within the consumer, I have to like consumer low ticket better than durable type. Actually, durables I don't like anyway, because I think everybody in India, if you see, everybody wants to have their own TV brand, and they want to make washing machines, and they want to make microwave ovens, and they want to make toasters. I think there's a limit to how many people or how many companies can do the same thing.
Right, Samir, let's talk about, the stocks that were in focus in the past week, particularly the tier 2 banks. In the past, you have been a big fan of the HDFC banking name, and you said you're keeping the faith out there. But what about these tier 2 banks, some of those RBL Bank, IDFC First Bank, Central Bank, the names that really don't come on the radar, but for the past week, suddenly they went up 10-20% odd. Would you?
So we have 1.5 of these names, because we have IndusInd also in our list. And from this, we have one small position in one of these, a new position from bought actually last week or maybe last week only. But now I'll have to see. And maybe if I reduce somewhere else, then, the financials might at least relatively outperform for sure. See, now the first question will be whether the FIIs, do they just slow down, or do they stop, or do they reverse for now, for let's say month to month, based on whatever is been, an outcome of this Jackson Hole. So let's see. But right now, today, I have no intention to buy anything much, to tell you clearly.
And, the other call that you had taken, I think, was on Zomato. You got in on that dip. What do you do from here on?
Nothing. Keeping, at least let us make some proper 50-60 return.
I recall you got it, I think 48 to 50 if I remember.
I bought a little bit more. My average has become 52.
Oh, okay. All right. So you're adding on to that position.
No, not now. We added that time.
Okay.
But whatever. So the bottom line is, right now, let me enjoy it because I can't be negative on everything together.
Samir, when you said that market here will outperform other markets, you essentially basically saying this largely a function of the mood here is people keep saying there's still people are very bearish, etc. But on Friday, futures were at 100-point premium, the largest premium in a year, Nifty futures. So is is this a function of what you're saying? Outperformance is a function of local flows. You expect them to be pretty strong, continue to be very strong.
Local have generally been strong. So even if they continue at current levels, I'd be okay. I was thinking more when I was saying that we are bullish. I mean, in this last 1.5 months and all was that I said that broadly speaking, the FII selling will stop someday, and by just chance it stopped sort of in July itself. But broadly speaking, my big picture thing was that every year FIIs are normally net buyers, and that has been the case in whatever 21 or whatever out of 25 years. So they will come back plus minus a few months. It just happened that they came back quickly. Now it again depends on if I want to be bullish in a good mood, I'll say FIIs are back. If I'm in a bad mood, I'll say yeah, they are back, but they bought what was sold by a foreign private equity guy. So in the end, how does it matter? But it matters because the guy who's buying is coming in today with a new enthusiasm and a new view of the world. And as I also tweeted last week or whenever we had this conference in Singapore, I think the Edelweiss conference, I mean, it was amazing how badly people have been hit in China. I was going to use a stronger word than I realized I'm on TV, but how badly they've been hit in China and really badly hit, which is causing them to have redemptions across their Asian funds, emerging market funds. And if you just put the four pockets, India, China, Europe, US, it's just easy to see that India is doing well, both in terms of inflation, both in terms of interest, and most directly in terms of relatively people moving a little bit, if not all, or most of their new allocations from China to India.
Yeah, okay. Samir, last time when we spoke with you, you said you are staying away from auto stocks. You're getting a FOMO feeling?
No. I don't feel FOMO. I have been around for 25 years. After some time, you will feel being included, whatever is called the reverse of FOMO. Don't worry.
JOMO. It's called JOMO, the joy of missing out.
Whatever it's called.
Okay.
What is JOMO?
The joy of missing out.
The joy of missing out. Correct.
Okay, well, the market is opening, Samir, so we'll just take a quick, quick read through in the market and then we'll come back to you. I think 10 seconds left and it's going to be a weak opening, no two ways about that. The pre-opening rates have settled about 370 points lower on the Nifty, just below that 17,200 mark. I think today it's going to be a secular move on the downside. 1,200 points gone on the Sensex, by the way. The first tick is quite ugly. Even on the Nifty, 370 points gone. The Bank Nifty is down 900 points. So straight off the back, it's a 2% slide on the indices. What's topping the charts on the downside is the IT stocks. So you have Tech Mahindra, HCL Tech, Infosys, Wipro, all down about 3 to 4%. And then you have the metal names. So the Tata Steel, Hindalco, that's under pressure, followed by names like SBI Life, Apollo Hospitals, Bajaj, Finserv, Adani Ports, Coal India. So nothing is spared really. All the stocks are in the red at the moment. I think it's just the domestic facing stocks that are outperforming a tad bit. So whether it's Nestle, HUL, ITC, Britannia, all the domestic consumption stocks, even the auto stocks not doing too badly, outperforming a bit, Bajaj, Auto, Maruti. All of them are in the red, but lesser than, the other stocks. So I guess today it's all about the global markets and the sell-off there.
Absolutely, it is. 347 points lower, so 17,212. Futures are still at a 8790 point premium on top of spot. So 17,292 is where the futures value is at this point in time. Let me just take a quick look at what some other stuff is doing, broader markets. So market breadth, of course, is some 7-8:1 in favor of declines. Tata Elxsi is down 5%. It's I'm just mentioning things with largest volumes. Zomato is down 4%. We were just talking about that, 59. IRCTC is down 5.25%, 681. There is Tech Mahindra, which is down 5.5%. 1,027 should I want to pose that tech IT question, IT services question to Samir. in a bit. RBL Bank is down 5%. RBL Bank saw a bit of a move on last week, 119. LTI, that is L&T Infotech, down 5%. Mindtree is down 4.5%. Happiest Minds is down 4.5%. KPIT Tech is down 4.5%. So it's tech. I mean, across the board, a fair bit of pressure coming through on IT services companies at this point in time. Reliance is starting. I mean, could this be a bit of a balancing factor today with the AGM? We'll see. 2,600 on Reliance. It's flat, 0.5% lower. That's about it at this stage. So, I mean, just to start, Nelco is up about 5.5% on the upside. Another one with volumes showing up early, 900 nearly on Nelco. Nigel.
Well, the start is quite ugly on expected lines. The low of today is around 17,180, so that becomes a crucial mark. We're going back there, and in fact, we're trying to bounce 20-30 points, or we're getting sold into. So just keep an eye out on this zone, 17,150, 17,180 odd. The problem is the breadth of the market. You have only 185 stocks that are advancing. You have one stock that's advancing for 13 stocks that are declining. So that's a bit of an issue. And the bigger issue from the index standpoint is the Nifty Bank. That's down 1,020 points odd, 2.5% low. And a lot of these banking names that put on weight last week, well, in fact, they are giving up pretty much everything. Reliance Industries, that's going to be the crucial factor for the second half of trade. We're drifting down now towards that 17,150. So 2.5%, 2.2% odd gone on the index. And if you take it from the recent peak, well, that would be close to around an 800-point correction is what we have seen. Well, we're in conversation with Samir Arora. Samir, thanks so much for waiting by. You said that we could easily give back what we have put on, maybe 8-10% odd is par for the course. The low that we made in June, though, do you think that level should hold out at least?
Well, I don't look at it like that. I didn't even know what the exact low was. But broadly speaking, in my mind, giving up 5-10% looks, not in one day or 1 week, but generally in this round is okay. So I don't look at it like that. I have no idea what exactly was the low when it was hit. I don't look at these things. So it doesn't stick with me.
All right. It was just 15,200. So you're just wondering where they had the view. But we take that point. You're expecting us to drift a little bit lower from these levels. Got that?
I wanted to take Sameer's point. I think the last time he spoke to us, he said he's staying away from IT stocks. I guess that worked bang on, Sameer. The stocks have been under a lot of pressure. Margins are at multi-year lows. But do you think this whole structural growth story of IT that has worked very well in the last 4-5 years has come to an end entirely? Or will it come back into fashion at some point?
No, some point everything comes back. It's not that it never comes back. The question is whether it comes back over the next 6-month type. Then, you can hang around and wait, or you then otherwise have to take some view. So I don't think it's easy for it to relatively outperform our market, whatever it may do in absolute, because at the end of the day, if the US customer, the European customer is under pressure, and whatever they may say about its secular, this thing that, obviously, they have to invest in technology, and then India is the back office for them, and India can handle new things that are happening. But, we know it, that if there is pressure on the end customer, then the whole supply chain has to share the pain. And also discretionary projects may reduce, and new startup businesses and businesses from these PE-funded companies may have come down already or will come down. All that has to happen if the whole idea of the Federal Reserve is to slow down and bring down the market in some sense. I think if the market doesn't come down in the US, then the Federal Reserve feels that, they are not taking me seriously.
I mean, markets rallying is easing, right? Conditions generally.
It's a sign of easing financial conditions, but even psychologically, if you keep saying, I will raise rates, and the market says, it doesn't matter, because anyway, X number of months later, you're going to cut it, then that is the signaling of no credibility. So then he says, no, now I'll show you even more. So the best is to act dead.
Samir, have you guys participated in any recent? There was this IPO Sirma. I mean, good company. Well,
no idea.
No, nothing. Okay.
Zero.
And all these blocks, etc. Also, which we've seen. You were referring to earlier.
No, so we didn't do it in the block, but we bought the Zomato like one day before because we bought on the result, and then the next day the block happened. And then the other ones, I didn't imagine that it'll be that. I used to think that's a big overhang. It turned out to be a cleaning up trade, but of that size, it was amazing. No, we didn't buy.
Which one was that? Zomato?
No, I'm saying the other blocks like that,
Okay.
Max.
Max,
Yeah, those
etc.
were
Yeah. Max, some 30% equity changed hands and the stock that day was up some 10%, right? Yeah.
But we didn't buy. In fact, till one day before, we used to think that, we are not buying this stock because there is such a big overhang. And how will this overhang be absorbed? But it was brilliantly done. But we were not.
So, just coming back to the overall market picture, Sameer, if this market or if global markets head into a recession by the end of the year, which is, I think, the base case at the moment, not just for the US, but even what's happening in Europe, right, with that major energy crisis. Do you think, how does it work for a market like India? Do you think money will move out of developed markets and into markets like India because the potential looks better here? Or overall, do you think risky assets could become unfavorable?
So I would think that these things don't happen in one shot, that if you are disappointed with one market or one stock, you instantly sell it to buy the other market or the stock. But over the next X number of months, with God knows how many, let's say 6 months, then once people reassess, they will then say, yes, India is doing better and it has outperformed and there is a logical case for why it has happened. Then you can get, but for example, if today a tech company comes out with poor guidance, let's say just for the heck of it, Infosys, in 30 seconds, people don't switch from Infosys to TCS. They would rather sell TCS also because they say, oh, it's part of the same asset class in this case, or in our case, industry. And then 3 months later, 2 months later, then they evaluate the two again and say which one to do. So I don't think that movement from developed to emerging happens in one stroke. It will first happen by them selling that, maybe not selling a lot here or selling less here, and then the Indian public buying its own market, and therefore we outperforming. And then over the next 3-6 months, you get the benefits of all these things that we feel we are doing well in, which is growth and tax collections, and that at least we are not having such high inflation, and that our interest rates are relatively higher than all these places already, and whatever else we may have done in the past few years in terms of reforms and everything else, digitalization or demographic. But it doesn't happen in 30 seconds that you get hit with the US market and you move that money to India or any other market.
Always good hearing your thoughts. Sameer, thanks so much for stopping by and filling us in with your view on the markets, the FIIs, and a whole host of sectors. Always look forward to chatting up with you rather soon. Well, the markets, we're lower. We're down 350 points. The intraday low is at around 17,160. So we're seeing a 40-point bounce from there. The sense you're getting is maybe this gap down opening is not such a bad thing from a bullish perspective, because you can't short the index down when it's close to around 400 points down. So just keep an eye out on the lower levels. Wait by for the next 30-40 minutes or thereabouts. By 10 a.m. odd, you could get a better sense on it. But for the time being, it appears the bulls are coming in to defend the 17,150, 17,160 odd mark. So keep that mark. Very, very crucial level is what we're looking at. And if things could swing around, then the Nifty bank is bounced, for example, 200 points on the day's low. If that happens, maybe a bit of a relief is what we could see. Well, for the time being, let's focus on a couple of sectors then. Let's focus on the housing finance space. Mr. Girish Kauski, the MD and CEO at Canfield Homes, joins us to discuss how are things panning out, as well as the outlook for FY23. Hi, Girish. Always good speaking to you, sir. Tell us, how are you seeing demand shaping up? Are things, solid? Are you seeing a good amount of traction on ground? And if yes, break it up for us. Where are you seeing demand coming from? The luxury segment, the affordable housing segment? Go ahead.
Good morning, Nigel. I think demand is still intact in spite of rates inching up, in spite of cost of construction going up. That's simply because I think the demand is quite robust in spite of these two small deterrents. Still, I think demand is looking quite good. It is looking good in almost all the segments. Maybe premium and super premium segment, I think there's been slight, comparatively, slight less demand. Otherwise, I think it's broad-based and it is pretty okay across geography as well. If you look at last year, quarter one was not that good because of COVID second wave. in spite of quarter one in last year not being well, most of the companies and the industry did well last year. In fact, most of the companies clocked highest ever numbers in the remainder 3 quarters of last year. And therefore, this year, I think at an industry level, 11 to 12% growth would look decent enough. So in that sense, I think demand is quite intact. There's been slight impact in the demand, but I think that's not big enough.
Okay.
To,
So, Mr. Kosgi, I agree that demand has been very strong. In fact, your AUM growth was what? Almost 24% year on year in the quarter gone by. Can you give us some estimates for the full year? What are you looking at?
Good morning, Sonia. No, we are looking at about 18% growth in both disbursements and book. I think there might be here and there quarter-on-quarter slight ups and downs. I think at a consistent level on a steady state, we look at 18% growth.
Right, Girish, what about your NIMs? You had indicated that maybe there could be some bit of tapering down out there. I think with the past quarter was in that 3.6, 3.7% odd. Majority of your borrowing, I guess, comes from banks. In a rising interest rate scenario, what is the steady state on NIMs you'll be looking at?
In fact, I've been saying this since last 9-10 quarters. I think for a company like Canfield, which is completely into retail, no corporate funding, no developer funding, non-home portion being very, very less in the portfolio, largely focusing on affordable. I think spread of 2.4 and NIM of 3. So today we are slightly above what I mentioned now. I think as a guidance in the long term, we should look at 2.4 and 3 for Canfield, because we are 100% retail affordable small ticket company. I think that is what we're looking at. I think it's possible that for next few quarters NIM could be around 3.5, 3.6, but I'm talking about long term. We should look at upwards of 3 and not less than 3. I think that's the guidance.
In Q4 of last year, you even managed to do 4.1% NIMs. You won't get to that level anytime soon, you think? Now that everything has recovered and there's big demand?
Yeah, I'll tell you, no one expected COVID. Yeah. Right, and how COVID had an impact on the entire industry in terms of growth, in terms of margin and profitability. I think in spite of COVID, we were able to maintain, because our guidance was forethought well in advance, and we had given a guidance of 2.4 and 3. And if you remember, I think spread came to as low as 2.41. So I think, which is why I always look at long term and say this is what is the long term guidance. In the short term, yeah, there could be slight ups and downs. I think market is looking good. Now, what we have done is we are pretty aggressive on growth. Because we are aggressive, our rates are very competitive. And therefore, margins from the current level would come down to a certain extent to ensure that we grow at a faster pace, because we are looking at newer segments. We are looking at slightly better profiles. We are doing very good profile, I think slightly better in terms of a ticket size, so that we can also grow the book at a faster rate. And therefore I say that margins, they could be little contraction, but definitely about 2.4 spread and 3% NIM.
Okay, all right, Girish, also give us a sense about asset quality. What should the numbers we work with on credit costs as well as asset quality for FY23?
Yeah, in terms of asset quality, I think last 10 quarters, I think our asset quality has been improving quarter on quarter in spite of COVID, in spite of moratorium, in spite of restructuring. I think on asset quality front, we are currently at about 0.65%. So it should be in that range, maybe plus or minus 2 or 3 bips. I think that will be pretty stable for next many quarters to come. In terms of credit cost, we don't anticipate any increase. So it will be in the range of about 0.12 to 0.13. I think nothing change on credit cost per se.
Okay, Mr. Kosgi, we'll leave it at that. Thanks a lot for joining us and giving us an update on the business. By the way, the market is still under quite a bit of pressure, so let's just keep our focus there. It's 300 points gone on the Nifty, 1,040 points gone on the Sensex, and the entire IT space is under quite a bit of pressure. So Tech Mahindra, Infi, HCL Tech, Wipro, TCS, all down anywhere between 3 to 5%.
Sonia, I think we should just keep an eye out on the index, because the day's low was at around 17,171. And from there, we've seen a good 80-point bounce. This is the point that we're making earlier today. Given that the markets are net short and we're going to see a gap down, it may not be such a bad thing from the bulls. So it seems for the time being, there's a bit of a recovery. No indication to say that we're going to last out, yeah. but at least the day's low, we've seen a bit of a bounce, which indicates either there's some kind of covering or there is some kind of bottom fishing as well. For the time being, 17,160 odd, that becomes the crucial mark you should look at. Prashant, you want to make a point?
No, I mean, I was saying the same thing, almost 100-point recovery, so which is not bad at all. And you know, the big one is not, I mean, I was talking about Reliance perhaps being a bit of a balancing factor, given the fact that, potentially a balancing factor, given the fact that there is an AGM. So will it work out that way? We just have to wait and watch. So far, I mean, it's not really pulling its weight. It's just down 0.5%, doing nothing, either on the downside or the upside either. Tahir Badshah is now joining us. He's Chief Investment Officer at Invesco Asset Management Company. Tahir, great to have you with us here on the program. Thank you very much for your time.
Morning, Prashant, and sorry for the...
You know, you've been, no problem. You've been a bit cautious all through, a little watchful because of valuations and the run-up, etc. How are things looking now, Tahir? I mean, we had Samir with us earlier, Samir Arora of Helios, who was saying that market can give up 5-10% easy. Not, of course, immediately, but from here, from these levels. Any thoughts at an aggregate level on the market from here?
So up until yesterday, I mean, you know, everything was on the table. Like as I mentioned the last time around, that, you know, markets are at a stage where after the recent rally, the risk reward was relatively more balanced, and it was open to risk because many of the uncertainties which were around had not completely you know, vanished and could come back on the table. And one such risk, once again, in the form of interest rates and inflation, has come back over the weekend. So I think things will look a little tentative from here on. I really don't know how much of correction can be possible after this, probably about 15% rally from recent lows. But yes, I think you know, if we probably get to levels which are at which you know, the markets once again trade below their averages, and we had moved you know, a little above our averages in the last move of the market. So I think you know, probably a correction of around 8 to 10% can probably put markets at less than 5-year average once again, and that becomes a comfortable point in my view. I think things will remain a little uncertain in the sense that, you know, look, there are both the factors which are at work. There's a tug of war in a way which is going on between the Fed and the consumer in the US. The Fed will try to do as much as it appears in terms of controlling interest rates and controlling inflation, and therefore raising rates as much as possible. On the other hand, the consumer out there is very, very resilient, so it's not going to give up very easily. It's not going to give up very easily either, which basically means that it's going to be a tough battle over the next 4 or 5 months, 6 months between the Fed and the consumer, and we'll have to see how it goes. So what we'll see is a duality. You will see a situation where interest rates in the US at least continue to rise, and at the same time, you will probably also see you know, growth indicators or economic indicators staying reasonably resilient too. So that's going to be a kind of a, you know, dilemma that probably the markets will have to face, and that will bring its own attendant volatility. In the meanwhile, however, in India, I think things are reasonably fine. It's very difficult at this stage to point out something which is significantly amiss as far as the Indian economy is concerned. But of course, the follow-through of rate hikes, etc., in the US will probably have its implications. Meanwhile, we'll probably also need to see as to what's going on in China. That's something that still remains relatively unclear at this stage. And that all that could probably induce that volatility, which could probably bring markets in India maybe less than their averages. And that's probably what the downside looks like.
In fact, we have learned from this entire episode that the best time to buy, Tahir, is when the worries pile up, right? Especially when the global markets act up. Perhaps that is the best time to look at Indian stocks. So if this run does continue on the downside, courtesy global markets, one wants to invest perhaps for the longer run. What would you look at? Where do you see pockets of value now?
So I think, you know, for some time, I think we've kind of been looking inwards. We've been looking at the domestic opportunities a lot more than the global opportunities. Things at home appear to be relatively more, you know, provide a lot more confidence across different kinds of sectors. Some part of it we have seen coming through in the form of a rally, whether it be in some parts of consumer discretionary, autos, industrials as well. They played out pretty well over the last some time, but they still remain go-to pockets for us on corrections. I think financials has been something that we have pursued for a very long period of time, and that's also an area which remains for you know, comfortable for us. So I think domestic stories largely, at least from a growth standpoint in the near to medium term, Meanwhile, Sonia, I think pockets of value are also will start developing or have started to develop in some of the globally oriented sectors, particularly tech, for example, is going through a fair bit of its own, rough journey. But I think somewhere, at least for our value strategies, we think we are getting into a mode where for the next 3 to 6 months, it'll be a good time to look at these from a value standpoint, not from the point of view of immediate returns or from the point of view of seeking immediate catalysts out there. But I think sheer value is starting to emerge, and that can be played from a 12 to 18-month perspective, I guess.
All right, I just hold on to that thought. We need to take stock of the markets. A good 100-point recovery is what you've seen from the day's low. More than 300 points on the Nifty bank. That was the one that took a hard knock in the first couple of minutes, and that's seen a good recovery as well. Breadth of the market, for whatever it's worth, you had only around 180 stocks are advancing. At least that number has moved to around 350 stocks odd. So just keep an eye out on that as well. Hi, Tahir. Good speaking to you after a while, actually. What about the auto stocks? I think that, you guys were relatively positive on them. And, that has worked out, actually, because everyone's, now talking about autos, auto ancillaries as well. Now, bulk of the good news is known, which has to play out in the second half of this year. Cooling off, commodity costs, easing out of chip shortage issues. But what from here on? What's your preference in that space?
So yes, you're right, Nigel. We've been reasonably positive, but things play out very, very fast in these kind of markets, and I'm surprised to see the kind of momentum which has built up so fast in this sector. Of course, some of the things have started to fall into place. So our preferences within the space has been for the four-wheelers more over the two-wheelers. Most pockets of the four-wheelers, whether it is commercial vehicles, parts of passenger cars, as well as maybe even agricultural equipment for that matter. So I think that still remains something that we prefer, but we've seen a decent climb in valuations responding to some of the enthusiasm which has started to develop around the sector, whether it is in terms of return of the consumer, whether it is in terms of demand, new model introductions, easing of commodity costs, steel prices, and so on. So I think we are somewhere in the mid-cycle of the auto consumer play where probably businesses are still mid-cycle, valuations are somewhat above mid-cycle, having played out. But I think earnings will remain reasonably strong and visible. So there will be one pocket at least, Nigel, where we probably will not have to contend with a lot of earnings disappointment as we go into the next 2-3 quarters. And that should keep investor interest pretty entrenched, even though the sector has seen some decent moves in the last couple of quarters.
Tahir, just to clarify the last bit of the last answer, you were talking about IT, which looks good from 12 to 18. Yeah, sorry.
Yes, to the last answer, yes, I was looking at IT as a value play emerging over the next 12 to 18 months. It's always difficult to actually pinpoint what will be the triggers, and especially in things which get into a value zone. But that's exactly what happened even in autos at the start of the year. There was, as you know, autos was not really a preferred sector within the market, and most of the things around it were negative. But things do change, and valuation had become attractive at that point in time. So I think something similar can unfold, and some of in
terms of IT valuations, or you're saying valuations should get better?
So valuations are getting attractive, is what I'm saying, with this massive underperformance that you've seen in the IT space over the last throughout calendar year 2022.
By the way, just want to point out, I know it seems like it's all gloom and doom in the markets, but there are some stocks that are bucking the trend. Syrma SGS, which was the new listing, is up another 9% now. And in any case, this electronic manufacturing services space has been doing really well. And Syrma has had a very good listing, and it's up a second day in a row. Any thoughts on this one, Tahir, before we let you go?
Well, we've not looked at this company. We've not invested in this IPO. So, but I think the space looks attractive, and there are a few other candidates also which are in play, and they've done, even they have corrected, and the meanwhile valuations are attractive. I think the space still looks attractive to us. Anything which is more domestic oriented, like I said, Sonia, is something which we need to examine very, very closely. And And that's what we are focused on.
You know, we had Dharmesh on Friday with us who was saying that there are more of these kind of companies which are going to come with IPO. So there's Amber, there's Dixon.
Yeah, he gave a long list of companies that are expected, a few hundreds, I think he said. And
that was the overall list, but like Sirma and the contract manufacturing, electronics contract manufacturing space, the EMS space, there are a bunch more.
I think Sirma, they got it right on numerous things, right? One was on the pricing. If you compare it with Dixon, you have a big revenue potential from here. They 1,200 crores last year. They can do close to 4,000 crores at optimum levels as well. And the money coming back to the company, well, you like to see that, right? You guys quite often talk about some of these OFSs where the money goes to the promoters. So at least, from a psychological perspective, you're saying, okay, the money's coming back to the company, so you like that.
And given how well the peers have done, right? Dixon and Amber have been multi-baggers in the past. I guess that's the expectation with this one as well. But Tahir, thanks a lot for joining us. Have a great day, week, and we will touch base with you again later. Hope to see you more frequently on the channel. Well, let's slip into a quick break. There is a massive energy crisis that's taking place in Europe. So we will connect with Ramesh Gehani of Endurance Technologies that gets about 25% of their business from the European markets. We'll speak to them about the impact in just a bit. Also, we'll connect with Keshav Bhajanka of Century Plyboards to discuss the demand and the business outlook. Stay tuned.